Are we going to pay or not? The world waits still to hear whether the U.S. will renege on its debts. This is Bloomberg Wall Street Week. I'm David Weston. This week, Nobel Prize-winning economist Paul Krugman on worrying about the growing national debt.
There's no hint that financial markets are concerned about America's ability to service its debt.
David Booth of Dimensional Fund Advisors on what generative AI could mean for stock picking.
Even though AI apps will have a lot of information, they don't have as much information as embedded in the market. So for my taste, I'm accepting market price.
And Hall of Fame quarterback Steve Young on a different approach to private equity.
Partnership investing will rule the world.
This week, there may have been a lot going on, but it seemed like all global Wall Street could talk about were those on-again, off-again talks at the White House over the debt ceiling, as Speaker McCarthy kept insisting there would be no default, provided there were spending cuts.
We're not going to default, but we have to spend less than we spent last year.
House Minority Leader Hakeem Jeffries responded that the cuts McCarthy was demanding just go too far.
House Republicans are determined to either extract deep, painful cuts that will hurt the health, the safety, or the well-being of everyday Americans, or crash the economy.
And President Biden conceded that there would have to be some spending cuts, but that there had to be revenue increases as well.
We got to get something that can sell to both sides. And we need to cut spending, but I think revenue matters.
And through it all, Wall Street insiders like Steve Schwartzman continue to insist that, in the end, they'll work it out somehow.
This is somewhat an issue of wills and desire to not blink. You know, the whole world is watching.
But despite all the budget sturm and drang, there were some other things worth paying attention to this week, like China's move against Micron selling its chips there.
Broadly, this action appears inconsistent with the PRC's assertions that it is open for business and committed to a transparent regulatory framework.
Fed minutes from the last meeting showed how uncertain the central bank is about where it is heading next.
The minutes show Fed officials were more divided than usual at their May meeting as they debated uncertainties about bank problems, inflation, and the debt limit.
And NVIDIA shot the lights out with revenue projections as the world stampedes to AI.
When you look at the data center market, it is white hot. People that are developing data centers don't even get them developed before one of the FANGs leases it for 30 years.
And then on Friday, U.S. economic numbers came in stronger than anticipated, with personal and business spending up, and the year-over-year PCE core deflator stubbornly up at 4.7%. But the markets for the week pretty much reacted to those two other stories, the debt ceiling negotiations and what AI means for tech, with the S&P 500 up 0.32% for the week, ending up just over that 4,200 number people have been focused on, and 200 points above our Bloomberg Elves median estimate for the end of the year of 4,000. The NASDAQ was up a whopping 2.5%, while the yield on the 10-year added another 12 basis points, ending the week just under 3.8%. To take us through the week in the markets, welcome now Lori Calvasina. She's RBC Capital Markets Head of U.S. Equity Strategy, and Gillian Tett, Financial Times Chair of the Editorial Board and Editor-at-Large U.S. So welcome back to both of you. Lori, let me start with you and what's going on with the markets. Given all of the nervousness on some fronts about the debt, it's surprising, at least to me, the equity markets didn't really react all that much, did they?
They didn't. I would say the market's generally been reacting by rotating as opposed to pulling money out. And if you talk to U.S.-based equity investors, they'll tell you, hey, look, we've seen this story before. The stakes are high, but we think a deal is going to get done. So they've moved out of cyclicals and into things like tech and defensives, which is generally what you see in debt ceiling drawdowns. But at the same time, we're hearing from the big kind of non-U.S. investors that they've been very worried about this. They don't know our politics as well. So I would say kind of the steadier hands, the more kind of even-keeled local investors are taking it in stride. That doesn't mean they don't care. That doesn't mean the markets won't react if we don't end up getting a deal. But there is a patience here that makes sense.
Gillian, as we talk right now, they're still going back and forth, promising there's going to be a deal, there's going to be a deal. There isn't one as of right now. But let's assume, in fact, they do get a deal done the way both sides say they will do. Will there be a collective sigh of relief? Will that really put some wind in the sails of the markets?
I think there certainly will be a collective sigh of relief. You've already had another of the rating agencies indicated in putting the US on negative watch in terms of the treasuries market. And we've had S&P downgrade the US back in 2011. If a second rating agency downgrades the US as well, then that would really change the way that the world looks at that US treasuries. So obviously, if that can be avoided, that would be a huge source of relief. However, the questions that investors are going to be asking is, how long is any deal going to last for? Is it just a sticking plaster solution for a few months? And then secondly, what kind of fiscal outlook does the US now have? Can they actually create that long-awaited bipartisan commission to get serious about trying to talk about both revenue and spending cuts in the future?
Yeah, that's the question we keep asking. We don't get an answer to, unfortunately, Gillian. Exactly. Laurie, the S&P is on something of a run right now. This year so far has been pretty strong. There have been those who said, that's wrong, that we should go bearish. We have a 4,000 estimate, basically median for our elves. You are one of our elves. You're a little higher than that, 4,100. But you're still below where we are right now. So do you expect the S&P 500 to come down by the end of the year?
So we've said it can be choppy through the end of the year. The debt ceiling has been something that we've been worried about as a potential downside catalyst. So if we pull that off the table, that definitely does brighten the outlook. Look, and we're at 4,100, and that's in part because we think valuations are about where they deserve to be. But I would say, one of my constant conversations with investors over the past few weeks has been, this is not a stupid rally. I mean, this is, something that has made a lot of sense. A lot of people are pointing at the tech trade saying it's not deserved. It's been one catalyst after another that makes sense, that's pushed people into those stocks, and the math has pushed the market up.
And what about earnings? You actually have a chart indicating that we actually are bouncing back a bit on the earnings projection.
I think this is one of the most underappreciated things going on in the market right now. If you look at the rate of upward revisions in the S&P 500, so just the percent of estimate revisions that are happening, changes that are being made to forecasts that are up as a percent of total, it hit 51% recently. That's important because it means we're technically back in upward revision territory, and 8 of 11 sectors are seeing improving revision trends, and 4 out of 11 themselves are in positive territory right now.
So, Gillian, this is all fine and good, but as Laurie sort of adverted to, it's a fairly narrow rally, actually. It's just a relatively few stocks really driving it. Gillian, should we be worried about that? Does that indicate something about the strength of the equity markets right now?
It is a fairly narrow rally. I think the bigger question hanging over the American economy right now is, how come there hasn't been a recession yet? Because I was down in Richmond in Virginia talking to a number of Federal Reserve officials down there about what's happening in the grassroots of the economy in the American South. And the unanimous message from people who are going out and about and interviewing businesses is that actually, although they've been expecting a recession, there really isn't much sign of a significant recession yet. And more importantly, there isn't much sign that price pressures are really sinking back to the Fed's target anytime soon. So in many ways, I suspect what's going on in the market is a bit of a relief rally, that there isn't a recession yet. As you've heard, the earnings are coming in slightly better than expected. But the really big question people are going to be looking forward to, if, and let's say if, the debt ceiling drama gets sorted out in the next day or two, is, what is going to happen with the Fed and inflation going forward?
So Laurie, what about that recession question? Because we have been hearing these predictions of a recession in 2023. It was going to be the second quarter, it was going to be the third quarter, now it's going to be the fourth quarter. Is it just a matter of timing, or is there a question even of whether there will be a recession?
I think there's a question, a legitimate one, about whether or not we're even going to get it, or if you end up getting something similar to 2015, 2016, which was pretty close, but not quite. And I think what's interesting, and I see this more from the lens of earnings, is that we're in an asynchronous cycle in terms of the economy. There are different industries and different sectors that are going through different processes at different points in time. If you think about sort of your inflation, sort of beneficiaries, the beneficiaries of higher interest rates, things like financials and energy, they saw big upward revisions last year, while tech companies, growth companies, supply chain-centric sectors were all seeing downward revisions. Now the tables have turned. Everything that was getting hurt last year is in a recovery, and things that were benefiting from inflation and interest rates ramping are seeing their downward revision cycle. That's a very, very confusing cross-current, but if you spread the pain out a bit, you could actually skate by without a true sort of recession happening.
One more before we turn to everybody's favorite topic, which is, of course, artificial intelligence. But Gillian, to you, you mentioned the Fed and what the Fed's likely to do. We got some strong numbers in this week, actually indicating both on the inflation staying up, but also the economy being quite strong. Where do you think the Fed is heading? Do you think they're going to continue to rise at all? And by the way, if you want to, you can give us the jobs number for next Friday. It's okay.
Well, if I did that, I'd be a trader. I think the Fed is under pressure to keep raising, keep tightening. It may skip that for this coming meeting and do a wait and see stance, but I certainly don't think it's going to cut anytime soon. And think the market projections of 25 basis point rise now is quite reasonable, given the fact that we still haven't seen a significant decline in the inflation rate and the economy hasn't yet shown signs of being in recession. I think in many ways the more interesting issue that the Fed's also facing, though, is it going to give any hint of rethinking the inflation target going forward? Again, one of the messages that came back from being down in the South earlier this week and talking to people is that a lot of the commercial real estate sector are constantly asking Fed officials, are you going to change the inflation target? There's a kind of desperate hope amongst many in that sector that actually the rate rises will stop because the inflation target changes. Now, the Fed's been very keen to squash that quite forcefully. But that question is going to linger and linger, particularly if the inflation keeps coming in higher than people had expected.
Gillian, thank you so much. Gillian, Tett, and Lori Calvasina will be staying with us as we take up the extraordinary performance of NVIDIA this week and what AI may mean for the markets and the world for that matter. That's coming up next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. Gillian Tett of the Financial Times and Lori Calvasina of RBC Capital Markets have stayed with us. We're going to turn to that subject, which is everyone's favorite subject now. It's generative AI. And if it weren't our favorite subject before, when NVIDIA came out with those earnings projections, it was really pretty extraordinary. So, Gillian, let me turn to you as an anthropologist, I must note. We have people saying this is as big as electricity or fire or the invention of the wheel. Are we overestimating what this generative AI may mean for us all?
Well, the reason why the NVIDIA stock hopped so dramatically and came out with extraordinary earnings is very much down to the dazzle factor, but also the confusion factor, because investors know that something big is happening. They don't really understand the technology. They don't understand the degree to which companies that are AI companies actually have a moat that can defend them from new rivals. And so there's a lot of uncertainty there. The one thing that's crystal clear, though, is that this is going to require a lot of computing power and a lot of chips. So people are grasping on anything they can see, the shiny new thing, to try and have a play at this whole wave. In terms of the significance of generative AI, it is obviously very significant. We've had AI for a very long time. It's all part of our everyday experience. But for me, one of the ways to explain what's going on is that as an anthropologist, I always used to joke that the one thing that AI couldn't do is have a sense of humor and tell jokes, because jokes are fundamentally rooted in culture, which is hard to describe and hard to define and often very contradictory. And most of the traditional platforms inside computers looked for logic and patterns and things like that. What you're starting to see with platforms like generative AI are machines that are so sophisticated and so good at watching people and replicating human behavior, even if it's not logical, behaving like an anthropologist, not a scientist, that you're starting to get AI platforms which are almost beginning to tell jokes. So it's really quite a big change in terms of what's happening. The big question, though, is what it means in terms of real-world applications and company valuations.
Well, I think this is good news for my wife, who has always questioned my sense of humor, so maybe I can use ChatGPT to tell some jokes. So Lori, let me turn to you here on how big this could be. Is this a new lease on life for all of tech, essentially? Because we saw tech really get beaten down last year, and now it seems to be coming back.
So look, I think this is another thing you can put in the category of rallies that have been deserved. And I know it's, sort of trendy to go out and say, the market is toppy and this is just all this AI hype and it's not deserved. I think there's a paucity of growth stories out there right now. And when you think about the conversation on reshoring that's been going on, I've been talking to a lot of investors about that in recent months as kind of the only big, interesting growth narrative out there. Well, now we've got something to keep it company, which is AI. Ultimately, my gut is that this is going to be another productivity enhancer, something very cool, something something very interesting that enhances productivity. Is it going to completely transform society? I'm not quite sure I'm in that camp. But in terms of the market and why it's getting so excited, I think it's because there hasn't been a lot of other things in this kind of category of secular growth stories to get excited about recently.
Gillian, I'm going to ask you to do something very unfair. You have a terrific column on Friday in the Financial Times about DIIA, I believe it's called, in Ukraine. Could you just give us 30 or 45 seconds on that? Because I thought it was really extraordinary. I'd love you to come back and really explain it in more detail.
As the DIA is an app the Ukrainians launched 3 years ago to enable Ukrainian citizens to do all the usual government functions that any of us ever have to do, not by going to an office and filling in paper forms, but on your phone with an app. And initially, it seemed like just a very minor tool that a few people might use for things like vaccination status in COVID. But these days, 70% of Ukrainian phones have this app. Half the population is using it. They're doing almost everything to do with the government on this cell phone app. And the key point is that not only has it meant that Ukraine's kept functioning even as refugees have flooded everywhere, because they've all got their passports and stuff on their phone, but it's also meant that they have one way potentially to try and cut down on corruption. And the crucial thing to understand, the reason why it's so important this week, is because they're trying to take it, the USAID is trying to take it and export it to other countries. And that shows that actually Ukraine is just about agriculture or industry, but maybe, just maybe, it will have a tech sector in the future as well that matters.
A tech export from Ukraine, how about that? And particularly if it deals with DMV, I'd be all for it. Many thanks to Lori Calvasina of RBC Capital Markets and Gillian Tett of the Financial Times. Coming up, could your friendly neighborhood chat AI beat the stock market? We're going to hear from investing guru David Booth of Dimensional Fund Advisors. He has some doubts about it. He's not sure that you can beat the market with AI. That's going to come up next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. The S&P 500 has had something of a resurgence this year, and one of our Bloomberg elves, Manish Kabra of Societe Generale, explains why with a chart.
So there is a AI boom. We looked at 14 AI ETFs, that whole US stocks. Within that, we found top 20 US companies which are widely held by these AI ETFs. These 20 companies, they contributed 10 percentage points returns for S&P since start of this year. So essentially, if S&P is up 8% this year, the top 20 AI boom stocks contributed 10%. Companies have to think about productivity in this backdrop. So there are, various parts of the market, various economies, various economic sectors have to take benefit of this.
So AI may or may not be helping along the stock market, at least right now. But the question is, what could it do for the longer term with respect to investments? And for that, we turn to a truly gifted investor. He is David Booth. He is, of course, the founder and chair of Dimensional Fund Advisors. David, thank you so much for being with us. You wrote a column in the Financial Times expressing some, if I can put it, skepticism about whether all of this generative AI may help us be better stock pickers. How do you see it?
Well, I mean, AI is going to be incredibly useful in a lot of areas because it can process such enormous amounts of information. And that's really what selecting securities is all about, is trying to figure out how much undiscounted information is out there. So at first blush, it looks like it could be incredibly useful. Although, regardless of how elaborate and extensive your AI is not as elaborate and as extensive as the market. You think of the stock market as just being, we think of it as just being this enormous information processing machine. That everyone in the world's out there trying to buy and sell securities, and it's their action that causes prices to be settled at reasonable levels. So we think even though AI apps will have a lot of information, they don't have as much information as is embedded in the market. So for my taste, I'm accepting market prices. Now, AI might be useful in execution in a variety of ways. It can be useful. But in terms of, if you say, how can I use AI to pick a stock? Well, it's the same old story. I know if you know things other people don't know, it can move quicker and more efficiently than they can. You can make money. But I don't see any. It'll be years before we can figure out whether AI is really useful or not, in picking securities. And the beauty is you don't have to do any of that in order to have a good experience. Because you can go out there and buy the market and accept, the prices as being set fairly, and the market. The evidence is over long periods of time, the market does an amazingly good job at setting prices.
So David, right now, obviously, we're in the infancy of whatever AI ends up being. And part of the issue is, as I understand it, the data. And do you have current up-to-speed data? A lot of the stuff is delayed, in fact. If we could get to a world where actually it did have as much data as the market has, could AI add a little something extra on that in terms of really detecting long-term trends and short-term trends, looking at what happened in the past? Could it be a little bit better, a little bit ahead of the market?
Well, there's always that possibility, but that's the history of money management, right? I mean, if you are a little smarter than the market, you can make money. But there's not much evidence that people can outsmart the market.
So, David, you've had a remarkable track record managing money, investing money over the 50 years, as you say. Are you using AI or machine learning at all? Are you experimenting with it in your own company?
Oh, absolutely. I mean, there are any number of ways AI can be useful, particularly all the back office functions and dealing with market mechanisms and trading, so forth. But at the end of the day, and we have algorithms we use as well. At the end of the day, though, we think it's important to overlay some human judgment on top of whatever algorithm you're using. There's almost everybody that's experimented with AI comes up with the conclusion that many times it gives you really screwy results.
So, David, as I say, we're in the early stages of AI. We don't really know what it is or how far it's taking us, but we have some people saying this could be as important as electricity or the invention of the wheel. Do you have a sense whether this could actually be a paradigm shift overall for the economy?
Yeah, well, for the overall economy, I think it should make the economy more efficient, and I think it'll create progress. It's just the history of progress is that involves change, and anytime you have change, you have winners and losers. So it's going to be a balancing act of who wins and who loses with AI. But on balance, it'll be a winner.
Well, and David, when you say efficiency, what I hear is productivity.
Yes.
We have been lagging somewhat in productivity growth, certainly in the United States of America, maybe globally. Do you have some hopes this might actually reinvigorate productivity growth? Could you help the economy overall?
Absolutely. At the end of the day, and this is where we kind of differ from AI, in that what really makes the market move and the economy move over time is human ingenuity. People out there trying to make their lives better and their companies better, and in doing that, it makes it better for everybody else. That's, I think back at, like in March of 2020, when there was a lot of fear in the pandemic, where's the economy going? And we didn't try to predict anything then, but we still had the faith that people, when they have something bad happen to them, they don't just sit there and take it. They figure out how to get back on track. And that's what's driving everything. And to the extent AI can be useful in helping people get back on track or help them improve whatever it is they're doing, it makes it life better for the rest of us.
David, thank you so much for being on Wall Street Week. Really appreciate it. That's David Booth of Dimensional Fund Advisors. Coming up, private equity has been going through a bit of a slow patch. We talk with two longtime players in the middle market private equity business, Steve Young and Rich Lawson of HGGC, about their partnership investing approach and why they think it's working for them.
Today, partnership investing is taking over the world.
By staying disciplined, staying in this size range, there's a real opportunity to create alpha for investors.
This is Wall Street Week on Bloomberg. Private equity. It's come a long way since Henry Kravis and George Roberts put it on the map with that $25 billion buyout of RJR Nabisco back in 1988, made famous in Barbarians at the Gate.
I'm talking about putting a mountain of money into everybody's pocket right now.
And it has evolved since Democrats tried to make Mitt Romney's role in running Bain Capital an issue in the 2012 presidential campaign.
It's a very healthy and positive debate. That doesn't mean the private equity world is going to enjoy it very much.
Today, private equity is a massive asset class with over $11 trillion invested and another $3 trillion in so-called dry powder waiting to be deployed. Although higher rates slowed things down at the end of last year, it's just beginning to show signs of coming back.
Fourth quarter of 22, you had nothing. Today, you actually have the markets loosening up for the right deals.
Leaving us all to look for that right deal. And to take us into the world of private equity, we welcome two people who are in it from HGGC. We have, first of all, Steve Young, who's the chairman of HGGC, as well as the co-founder. And we also have Rich Lawson, who's the CEO and also co-founder of HGGC. So welcome, gentlemen. It's great to have you here. First of all, give us a sense of how HGGC fits into this world of private equity. Steve, you want to go first?
Sure. Thanks, David. You know, from the very beginning, from our roots, we decided that we wanted to do private equity differently. And we believed that across the table were people that were founders, financial sponsors, management teams. Across the table is somebody who cares more about who I am than the last dollar and what I bring to the table than the last dollar. And the fundamental principle is that partnership investing will rule the world. And 15 years ago, that was a little bit of a bet. Today, partnership investing is taking over the world. And so for us, the differentiation that we make is that we live here. We seek your reference across the table. We need your reference at the end of this engagement because that's how we're going to go forward, because that's all we do is partnership investing, where others will say, we're partnership investors, but they rent here. They rent here for the time, and they don't really, it's not rooted who they are.
Rich, this partnership investing sounds really nice, and I can understand why you might attract a lot of deals that way. Can you make as much money? Because that's not, let's be frank, the model historically associated with private equity. We think of it as coming in and buying it, stripping a lot of costs out, and reselling it.
Yeah, I think it's really important, David, to caveat that where we focus is in the middle market, so medium-sized businesses. So for us as a $7 billion private equity firm, where we tend to see the opportunity to create real alpha is buying good businesses in the middle market as traditionally defined, with the goal of transforming them into great companies.
So, Rich, it sounds like when you come in, it's not the management team that you're replacing. You don't come in, by definition, you pick companies that have good management teams. So what is it you're providing? Is it capital, basically? And typically in private equity, we think of leveraging up. Your capital is equity, as I understand it.
We would think about it in sort of three different deal archetypes. One is buy and builds, very important in this type of macro environment. The second would be in business transformation, helping upgrading core capabilities and processes. And third is growth enablement, maybe changing the go-to-market process, the go-to-market motion, helping businesses go global. But again, we're taking very distinctly medium-sized companies, call it $1 billion of enterprise value and below, and we're creating multi-billion-dollar enterprises over the course of a partnership with the owners of that business.
Steve, I understand you focus on the middle market, if I can call it that. Are there particular sectors that you tend to be attracted to or see deals from?
We live in Palo Alto, California. That's our base of operations. So we've been in technology for 25, 30 years. So we're going to do some technology, no question. But how tech has informed places like business services, financial services, and even some consumer in particular places is where we will kind of trade. We won't go further than that, but that's a pretty wide swath. But we are gaining, through our thematic sourcing efforts, some real expertise in our shop. And, we are now trying for the first time. You'd think I've been in kind of working to do a sports angle and sports investing from the very beginning of my previous life. But I took my heroes, Roger Staubach's, he told me that when I first retired, I said, what should I do? What's your recommendation? Is just run. And so I ran. And so I felt a little bit awkward reinvesting back into sports. But now I've kind of matured in my private equity life that I've been in longer than I played football.
Well, I was going to ask you that, Steve. Obviously, given we all think of you with a 49ers helmet on, that's the way we know Steve Young. Given that, do you get more deal flow out of sports? Do people tend to come to you? And I know you've done a lot of work actually with other former professional athletes to help them in their business ventures.
So one of my passions is to try to pay it forward and trying to create a repository of transition stories from professional life into the next phase of their lives. And I've always talked about that as a hard ending to a passion for people, and then finding out that they're middle-aged and they don't have it. I was great at something, and the next day I'm not good at anything. And so how do those transition stories and how to pay it forward for other athletes today? I'm really passionate about trying to figure out how to tell those stories about people who have transitioned, good and bad. My transition story was one that I'm grateful for, because I went to law school. I was playing. That degree allowed me to join with Rich 25 years ago and get into private equity, and I'm very grateful for that. But sports is you'd think that I would have been doing this the whole time, but I did. I ran away from it, and I didn't do it much. And so we are not we don't, in our portfolio of 48 platform businesses and 600 add-ons, very little touch sports, if you can believe it. But today, I think going forward, we're looking now, and we're trying to use that unique kind of previous background that I have to kind of add to the possibilities.
Rich, Palo Alto, last time I checked, is in Silicon Valley. We had Silicon Valley Bank. Has the failure of Silicon Valley Bank and some of the other regional banks, has it affected your business?
In a way, it's sort of accelerated the opportunity around this tilt towards partnership. We find that really large and growing ecosystem of venture-backed businesses are looking for outcomes, right? You have an ecosystem of venture capital and growth equity investors. You have wonderful entrepreneurs that are around these businesses. But if you think about what Steve had mentioned, the essence of what we do, we're looking for folks that in the kind of businesses that we're transforming from good companies or good businesses to great companies is numerous owners. And so what we found, David, is that because of what's happened with the macro environment, with SVB and others, you have this really large universe of smaller companies that would have typically raised a Series C, D, E, F and gone public that have now said maybe it might be better to join forces with one of our core active portfolio companies.
Rich, one of the precipitating causes of what happened at Silicon Valley Bank was the higher interest rates. That really took down the valuations of a lot of private equity companies. In fact, this week in the Financial Times, there was a lead article on that subject for private equity. Is it affecting your business, Rich, the diminishment, I assume, of the valuations given what's going on with the discount rate?
Well, David, I think, and Steve and I talk about this all the time with our team, in uncertain macro environments, business quality becomes more important than ever. And because these companies tend to be more resilient in the face of macro pressures, the type of businesses that we look for, invest in, help support, transform, even if they do get impacted in the near term, you will see them rebound quickly.
Steve, I can't let a Super Bowl most valuable player quarterback go without asking one question about valuations of professional sports teams. They are through the roof as we talk to people. It is just extraordinary. And I talk to some of the investors who say they're going to keep going. What do you make about some of the valuations we're seeing now on some of the pro teams?
David, my stat might be a little bit off, but it's not a lot off. 75 of the top 100 shows on television, highest rated shows on television, 75 of the top 100 were NFL football games. Think of the power in that stat. Equity values have 20 times in the last 20 years. And, people say players are paid too much. Quarterbacks are making $60 million a year. As far as equity value growth in the last 20 years, quarterback salary growth is only half of it. And so I'm not saying they should be paid more. I'm just saying that equity values are through the roof because of the power of live television. And you've seen that around the sports world. And NBA and Major League Baseball was on its back 20 years ago. I'm overstating it, but now flourishing because live television runs the world, and the NFL runs live television by a long way. So you talk about the power of the NFL, that power only grows. And that's why you think, a 49er team that's worth $8 to $10 billion, Could be 20 billion, could be, I mean, the upper ends are, who knows? But the NFL's done a great job of building equity value, that's for sure.
Gentlemen, I can't thank you enough for joining us here on Wall Street Week. That is Steve Young, of course, as well as Rich Lawson of HGGC. Coming up, there's a big fight in Washington over the deficit. But should there be? We ask Nobel Prize-winning economist Paul Krugman.
What really bothers me, where we are right now, is that the programs that apparently are sacrosanct are programs for the elderly.
That's next on Wall Street Week on Bloomberg.
I thought Hamilton had it right. He said a national debt could be a national blessing. And the national debt, having a liquid market there, provides a good benchmark for the private sector. It probably underpins the role of the dollar in the world. It allows the Fed to conduct monetary policy easily. I think we have to keep in mind the costs of paying down the debt. There is, among some people, a single-minded focus on it. But there's no free lunch in this world.
That was Larry Lindsey, President George W. Bush's director of the National Economic Council back in 2001. That was a time when the concern was not about how big the federal debt was, but that we might actually pay it all off. To explain today what we should and should not be worried about when it comes to the debt and the deficits we're running up, we welcome now Dr. Paul Krugman. He's Distinguished Professor of Economics at the City University of New York and the recipient of the Nobel Prize in the Economic Sciences. So, Dr. Krugman, thank you so much for being with us. We hear a lot of talk from politicians in Washington, as we should, about the debt. We don't hear as much, I don't hear, about the economics of it all. Why don't you give us your analysis of what we should be concerned about with the debt and what we should not be as concerned about?
Okay, there's a pretty strong case that debt is just a number, that the United States, absent the political games over the debt ceiling, which is a really uniquely American dysfunction, aside from that, there's no hint that financial markets are concerned about America's ability to service its debt. There's no real sign that the debt is putting any strain on the economy. U.S. debt is very high by our own historical standards. The only time we've been close to this level was in the immediate aftermath of World War II. But it's not that high compared with what a lot of other countries have experienced over the years without any kind of crisis. So, the numbers are enormous, but everything about the U.S. economy is enormous. So you say $31 trillion, and you do your best Dr. Evil imitation, but it's not at all clear that the debt is a top priority, that it's a catastrophic issue, or even that it even belongs in the top 5 or maybe even the top 10 of issues to concern the United States.
So maybe not catastrophic, but is it a growing problem in this sense? The debt itself is just one number. What about when you put it together with another number, which is debt service? Because as I understand it, part of the question is how fast is debt service cost growing? We have had essentially zero cost of debt service. Those are going up now. Does that pose a real risk?
The idea that that we're in some kind of debt spiral where we have to borrow to pay interest, and then we have to the numbers don't support that at all. The numbers don't suggest that anything like that is going to be a problem for the foreseeable future. So no, I mean, we've gone from a point where money was, free, or even in real terms, possibly the federal government was being paid to take on debt, to one where it costs something, but it's still pretty small.
So let's talk about some of the proposals about how to avoid raising the debt too much, and that is some capping of spending, particularly discretionary spending. What are the possible consequences of that if, in fact, we do freeze or reduce spending off of 2022 levels?
What really bothers me, where we are right now, is that the programs that apparently are sacrosanct are programs for the elderly. Medicare, Social Security are off the table. They're being protected. And a lot of the stuff that's discretionary is really things like programs that support children, that support education, that support nutrition for the young, which is the future. So what's happening right now is that in the effort to hold down headline spending right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
So that is a terribly important and very unpopular point, going back to the politics for a moment here, and that is when you say, let's cut things for the elderly. That's not very popular. I'm elderly at this point. But at the same time, we're not really investing in future growth, as I understand it, by paying more, for example, on Social Security, whereas investing in education or children or infrastructure could increase the future growth. To what extent do we need to be concerned about growing ourselves out of whatever debt issues we have?
Well, to a large extent, that's going to happen anyway. I mean, when I say you need to adjust for inflation, you really also need to ask about growth. And, the example I always like to use is, how did we pay off the debt from World War II? And the answer is we didn't. We had slightly higher debt when John F. Kennedy took office than we did on, when we declared victory over Japan. But the debt had dwindled. It was less than half the share of GDP that it had been at the end of World War II, because we had a growing economy and a little bit of inflation over that period. And that's largely, we're still in a world where we really are already set to, if not exactly grow out of our debt, at least not have it grow very much, uncontrollably, unless we do some really even more irresponsible things than we do now. So, and look, if you want to try to accelerate economic growth, there's not a lot of things that we know work. Investing more in children's health, nutrition is one of the things that we do know works, but it works with a very long lag. It's something that will show up 30 years from now in a better economy. Aside from that, if you ask what can we do to make the economy grow a lot faster over the next 10 years, the answer is nobody knows the answer to that.
So, Professor, you referred to the size of the debt going back to GDP. Right now, the projections, I think we're somewhere around 97, 98% of GDP, something like that right now. And the projections from CBO, as you know, go up to 120% and maybe keep going. At what point do we become concerned about that? You say now it's not a problem, but when does it become a problem? When would you start saying, wait a second, we're running into trouble?
It's hard to come up with a number. And, we look at Japan with 200% of GDP, and Japan has lots of problems, but unwillingness of the market to buy Japanese government bonds is not one of them. I like to point out that if we go back to the Industrial Revolution in Great Britain, first half of the 19th century, Britain had debt that was 180% of GDP. At the end of the Napoleonic Wars. By 1850, it was only down to 130% of GDP. And this is the Industrial Revolution. This is the birth of the modern age, taking place under what anybody now would say, oh, that must be a crippling debt burden. So, is there any? There must be somehow. You can't have our debt can't exceed our total national wealth. But we're nowhere close to that. And I don't see any number anywhere in these projections that is one that, based on history, would lead you to be concerned.
One of the things we hear about from some quarters, at least, is a concern about the strength of the dollar, that, in fact, the globe will lose some confidence in our fiscal abilities here in the United States. And we have seen sort of a dilution of the dollar as the reserve currency of the world. Fewer transactions, as I understand it, today are being transacted in dollars than before. You've written about the fact that you don't think there's another currency that will overtake it, but that perhaps it will become more of a plurality. Is that a likely development? And if so, what would be the consequences?
I always say that the big problem is not that something else might take the dollar's place. The problem is that there may be nothing else that can take the dollar's place. When you think about the alternatives, the euro is, unfortunately, because of euro crises and divergences, there's not a euro bond market. There's an Italian bond market, a German bond market. So that's a fragmented market, which means that euro securities are not liquid in the way that dollar securities are. China has capital controls. It has an authoritarian regime given to making erratic, sudden changes in policy. Who wants to use RMB as their key asset? Japan is just too small an economy. So, it's not that the U.S. derives a huge advantage from the fact that the dollar is the currency in the world. It's that the world derives a huge advantage from the fact that there are safe, highly liquid assets that can be used as collateral, that can be used as the sort of underpinning of the whole world financial system. And those safe liquid assets are US Treasury securities. And if we manage to destroy the credibility, then the whole world, including us, but not the whole world, suffers. It's not that somebody gains at our advantage, it's that we undermine the whole system.
Okay, Professor, thank you so very much for joining us. That's Professor Paul Krugman of the City University of New York. Coming up, would a rose by any other name smell as sweet? Some people seem to think so, including maybe even the Fed. That's next on Wall Street Week on Bloomberg. Finally, one more thought. What's in a name? Shakespeare had Romeo ask that question to suggest that this perceived difference between his Montagues and his beloved Juliet's Capulets shouldn't come between them. But in today's world, how a person or a product or even a country is perceived can be all important. Take, for example, Korean car company Hyundai. Once perceived as a reliable, inexpensive, rather boring alternative to high-priced and flashier European alternatives, it has gotten a whole new lease on life, creating adventurous designs for the EV world, making it a formidable competitor even to Tesla, causing the Wall Street Journal this week to ask, how did Hyundai get so cool?
It's an Ev, rhymes with Kev.
And it's not just Hyundai that's looking to freshen up its brand. Consider Facebook, with Mark Zuckerberg going so far as to rename his entire company in a bid to make up some lost ground to TikTok. Though the arc of his space shot to the metaverse may get bent a bit by the gravitational pull of generative AI.
AI is already crucial to the foundations of the metaverse and will be even more so in the future.
All this rebranding has now apparently made it all the way to the Oval Office, as the New York Times caught Speaker of the House McCarthy, as well as House Minority Leader Hakeem Jeffries, holding an important debt ceiling meeting with the president wearing those flashy dress sneakers. But before we get too terribly excited, it would be well to remember some famous instances where attempts to rebrand fell well short of the mark, starting with the auto industry itself. Does anyone remember the campaign in the late 80s to make us think that the Oldsmobile was really for young people?
In short, the new Cutlass Supreme is not your father's Oldsmobile.
And has anyone seen any Oldsmobiles around lately? Or how about that so-called new Coke? It was going to revive a time-honored brand.
New Coke is catching on. The taste is better and newer than. You said the P word.
Rebranding has been known to extend even to the world of geopolitics, as Secretary of State Hillary Clinton did with her famous campaign to turn things around with Russia.
We want to reset our relationship.
Looking back on it now, in the light of Ukraine, it's not clear exactly what the world got out of that particular rebranding. Even the central banks are getting into the game, with the debate raging this week about whether the Fed would execute a pause or a skip at its June meeting.
I'm not a massive fan of these linguistic acrobatics that central banks end up getting themselves into.
But maybe the place where we need rebranding the most is in how Washington deals with things like budgets and deficits. Oh, yes, the full faith and credit of the United States of America. But that may take more than just a new logo or new shoes with white soles. For that, we may need a fundamental rethinking.
The point is we need a new spending process.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.